Michael, thank you so much for coming to our studios. You are a chief investment strategist, Pension Partners, but you also write all over the major news channels and financial news channels.
Sure.
And today, as in the whole week that we've seen, Greece colors Wall Street, and everyone is talking about Greece leaving the euro. Is it such a bad thing after all?
I don't think it is. The problem is everyone is afraid that volatility, the fluctuations in risk assets, will repeat their performance going forward in a way similar to the end of last year, meaning that as the Eurozone crisis comes back, that risk assets start to act very violently once again. Now, if Greece leaves, I'm not sure it's that bad of a scenario. Why? Greece leaving means they can suddenly put back their own currency, the drachma. If they put back their currency, they can devalue that currency to make exports competitive and in turn try to cause a recovery in their own economy. So effectively, if you think about currencies movements,
yes,
when currencies rise, that makes you less competitive. Why? Because your goods to foreign buyers are more expensive. If your currency falls, then your goods are cheaper. So one way of thinking about currency is a falling currency imports inflation. A rising currency exports inflation. Now, Greece desperately needs inflation. That's how it can resolve its huge debt load. The fear is that if Greece leaves, what will happen to the other Eurozone countries?
That's
what
right.
happens to Spain? What happens to Italy? Will there be then a cascading effect in terms of the core of the Eurozone? I'm not sure it's going to get to that point. Markets are afraid of that. Low bond yields, not just in the United States, but in Germany, are basically reacting to that possibility. But I will say this. In psychology, when you present a narrative to an individual, when you create a story, individuals tend to overestimate the way the story plays out. So there's this natural bias in the human mind to believe that once you create a story around something, it's going to play out that way. The story of Greece leaving, the story of Spain leaving is very, very seductive. It's a very powerful narrative that people can latch onto. It does not mean that it has to happen. Now, if that's the case, money is betting on that overestimation of what happens with Greece leaving and the negative effects of it. That means that everything that we're seeing may not play out the way everyone thinks. The contrarian trade is actually to believe that Greece is a good thing leaving. The contrarian trade is to believe that Europe will be fine.
But when? Let's talk about the timing, because Forex Concept or some people say that this is going to happen as soon as next month in June. Citigroup said it's going to happen within the next 12 to 18 months with a 50 to 75% possibility. What is your take in it?
It can happen literally any time. The thing is, Greece has really been known since roughly the flash crash, May 6th of 2010. So it's not like this is news. And if you look at deposit flows, a lot of money has already left Greece. So if Greece says, okay, we're not going to accept the bailout, if Greece says we're going to be out of the Eurozone, money has already protected itself. So if it happens quickly or not, the process has been ongoing for now over 2 years. So in many ways, it's almost like, is it better to rip the bandage off now, have it happen quickly and just resolve the scenario, or do you let it drag out? I think the market actually would be relieved if it happened in the next month.
And what happens next? Some also say that if Greece leaves the euro, it's a good thing actually, because Europe will turn to Spain and Portugal and they will try to help. Do you agree?
There's an argument that if you remove the weakest link in the chain,
yes,
the chain gets stronger,
right?
And there is a feeling, so there's this other interesting scenario here. If Greece leaves, there's a lot of bets that the euro would decline because confidence then in the euro decreases. But if the euro declines, it benefits Spain. It benefits Germany, which would fit a large portion of any kind of bailout to Spain, simply because a weaker currency means you're exporting more, which brings more money into the Eurozone. So Greece leaving might actually benefit other countries because their currencies drop as a result of Greece leaving, which in turn causes that bailout to occur in Spain and in potentially Italy if we were to see a repeat of November.
And if it happens, they talk about the banking system, because how strong it is, the liquidity issues, and also in addition to that, austerity versus growth. What are we going to see? Is this going to be a big collapse? Is it going to be a 6-month first wait and see period, and then everything is going to a little energize?
I suspect there's an element of that, but there's a very important thing here to realize here. In the case of Spain, in the case of their banking system, while we are told that unemployment is, I think, roughly 24, 25% in Spain, there is a huge underground economy whereby things which are not reported by government statistics probably means that the country is in better shape than we all think in terms of the individuals. Taxes aren't getting paid. People don't show certain financial assets that they own to the government. So the view that we have on Spain is actually probably skewed much more on the negative side. Coinciding with that is the reality that despite Spain having a huge housing bubble, the delinquency rates, the rates under which people are not able to pay off their mortgages, is actually much less than you would expect given high unemployment, which confirms the idea that actually there's much more liquidity, much more assets. It's just that they're not reported in the official government statistics. So while Spain is a problem, it's probably not as big of a problem as we think.
And let's talk about the U.S. market. U.S. market has been reacting to Greece and France and all what's happening in Europe and Euro, of course. But how about inside as the economy? Isn't it strong enough to shield it?
So the performance of the stock market is telling you that the U.S. is much stronger than people give it credit for. Consider that you have in the Treasury bond market here in the U.S. yields which are basically at panic low levels. Essentially what happens is when people are afraid of what's going to come in financial markets, they go into safety. Safety is U.S. bonds. As money goes into U.S. bonds, yields, interest rates drop on that safety trade. Now, these yields are at incredible low levels. I believe the 10-year today is nearing its all-time historic low. Meanwhile, the U.S. stock market actually, despite it being volatile, is holding. It's not declining in a very precipitous way. It's effectively holding around this level. That suggests that investors in the stock market are not convinced that the world is going to end, are not convinced of the fear that is being expressed in the bond market in the U.S. Low interest rates are stimulative, not just indicative of a weak economy. Usually, when you think about low interest rates, it's a sign that things are weak. It's a sign that there's no demand for money. However, companies are raising dividends. Earnings have come out much better than estimates. The state of the U.S. economy is much, much stronger given corporations which are much better off than European governments. And that's, I think, this dilemma here for the very bearish investors. It's hard to get very negative on U.S. companies when they haven't really performed that well to begin with, and they're raising dividends, which makes their attractiveness to low-yielding bonds even higher.
You say that support levels are still here, and still, the S&P 500, in spite of the good economic data and good corporate earnings, is down 3% from the high of April 10th, I believe.
Right.
And what are your technical levels? What are your levels towards the end of 2012?
If the negative narrative, which is the negative story, if that does not play out, meaning that if Greece leaves and things are okay, if Spain is able to get its house in order, if the true black swan, the true surprise event is not that things blow up on akin to Lehman, but if things actually improve, if that's the true black swan, then why can't you have stocks make new all-time highs, especially when you consider that performance chasing by individual investors, not just in the United States, but globally, is pushing money into risk-free government debt. As money gets comfortable with the risk, that money can reallocate away from bonds and into stocks. So it's entirely possible.
Are the stocks cheaper in the United States?
Relative to, it's an entirely a relative argument. The idea of safety really is, it's safer, but there's nothing that's really safe, right? Bonds are perceived as safer than stocks. However, if you really think it through, the U.S. government has $15 trillion of debt. We're told that the U.S. government debt is safe. Yet Apple, as an example, has huge cash, has no debt, and has a dividend yield which is roughly the same as 10-year treasuries, and Apple is global and it has growth potential. So from the perspective of what is safe, Is U.S. government, which has $15 trillion, safe, or is Apple safer, given equivalent balance sheets?
Talking about the safety, you had an article which said the bear paradox and the negative narrative, in which you say there's a real dilemma here for the bears.
Right.
What do you mean?
So we saw, I think 2 days ago, Intel raise dividends, and we've seen a number of very big companies increase dividend payouts, increase the capital that they're giving to their shareholders. Now, if you have a big correction, stock prices decline heavily. As stock prices decline heavily and dividends remain where they are, the yield that stocks have increase. Now, if you're betting on a big decline in the stock market, you are automatically betting that money continues to go into bonds. But bonds already are yielding incredibly low levels. So a big correction means yields drop further, which makes the interest rate of the 10-year not 1.8, it becomes 1.7, 1.6, 1.5. Meanwhile, as stocks decline, Apple's dividend yield goes from 1.7, 1.8, 1.9. So you have the spread between dividend yields and treasury yields widening tremendously, which makes stocks even more attractive. So from an asset allocation standpoint, this idea of a bear paradox is you have such low yielding levels for bonds that if you have a correction in stocks, it makes stocks automatically much more attractive on a relative basis. So, and I think it explains why in general the US market has not fallen hard, or at least as hard, as Spain and Italy off of the highs.
From what you said, should I come to the conclusion that there shouldn't be a sell in May, go away now, now that we're in the month of May? What do you think, Michael?
It looks like the sell in May is happening more in overseas markets than in the US. But I will say that, you know, resiliency is a very important component to how a bull market is formed. If you have stocks stable in relative terms to other markets overseas, if there's a positive announcement coming from Europe which could cause a move higher in risk taking, then this idea of sell and may go away ends up not playing out. In 2003 and 2009, which were both reflationary periods, meaning periods where you came off of the deflation scare of the year before, sell in May did not work. Stocks continued to rally despite all kinds of fear that you'd have a continuation of a recession, that you'd have a continuation of a deflationary scenario. This year, you have almost a very similar setup. You have a lot of money which is betting against stocks. You have bullish sentiment which has fallen off a cliff. You have massive reallocation away from stocks into bonds. You know, we're told that stocks can go up if you have demand. You can have stocks go up if the supply is exhausted. If everyone has already done the sell and may go away, a little bit of an increase in demand will cause new highs.
Thank you so much. I have so many more questions, but our time is up. Next time you come, we need to ask you where to look in the international markets and Fed QE3 possibility, if
Absolutely.
any.